Hello, everyone, and thank you for the opportunity to have this conversation with all of you. Thank you very much to Pepperstone for organizing this wonderful event, Trading the Headlines, in which I have the pleasure and honor of sharing panel with such great minds in the investing business. It is an absolute pleasure, and I would like to discuss what has happened that has changed investors' mindset so dramatically in the last few months. If we look at a few months ago, prior to the end of 2021, in general, all surveys showed that investors were fundamentally bullish about 2022. There were significant expectations of rate hikes, and there was obviously already a perception of inflationary pressures building in the economy. The Ukraine war had already started, and the general sentiment started to be a little bit more prudent, but mostly bullish. Positioning from investors was certainly bullish, and net long positions from both hedge funds to the exposure to the cycle of long only investors were clearly something that was showing a little bit of complacency. What has changed in the first months of 2022 is mainly the realization that the combination of the macro environment, the geopolitical events, inflation, and monetary policy, instead of flowing in a way that would cement the strong view about markets that investors had, were moving the other way around. On the one hand, the idea that inflation was going to be transitory was certainly one of the biggest mistakes of the average of consensus estimates. We started with a mention saying that inflation was fundamentally due to the base effect of the reopening. Second, we heard it was temporary. Then it was, they said it was largely temporary. Now, persistent inflationary pressures are viewed as something that is the norm, not something that is sort of a one-off event. And this is important. It's important that we spend a little bit of time on this. Why do we have these levels of inflation? Inflation is always a monetary phenomenon. If we look at the period in which they said that there was no inflation, what we certainly saw was inflation in what? In financial assets. We saw multiple expansion in equities. We saw bond yields collapsing to all-time lows, and the number and amount of negative yielding bonds rising to all-time highs. We saw multiples in private equity and infrastructure investments reaching all-time highs. And at the same time, we also saw cryptocurrencies rising. It was called the bubble of everything. Everything was expensive. Monetary policy was extremely aggressive, and at the same time, very loose in an environment in which CPI inflation, i.e. core prices of goods and services, was not high. What happened in 2020 is that what was initially asset price inflation, real estate, infrastructure, equities, bonds, cryptocurrencies, etc., went to the prices of the goods and services that we purchase on a daily basis. Why? Because in 2020, in the middle of the lockdown, certain main central banks, the most important central banks in the world, massively increased global money supply to levels unprecedented, to levels that were not seen even in the quantitative easing period of 2008 to 2010, and to such incredible levels that we saw increases of money supply of 20-25%. And that money supply, instead of going through the transmission mechanism of monetary policy that left most of the money creation in financial assets, fell through and permeated goods and services, because most of that increase in money supply went to finance government spending, current government spending. When the lockdowns ended, the economy reopened. What happened was that to the recovery of demand, we added the artificial demand coming from excessive monetary policy and government spending. And those stimulus plans were not stopped. In fact, they were prolonged. Therefore, inflation not just continued, but continued so that it fed through core inflation, excluding energy and food. The Ukraine war is an important factor, and global supply chain disruptions is also an important factor. But all prices do not rise in unison if it's not because of an increase in the quantity of money. 1, 2, 3, 4 prices can rise due to exogenous reasons. However, all other prices would fall for the same amount of money, for the same quantity of money. Therefore, monetary policy has been an integral part of the reason why today we have elevated, persistent, and feeding to core inflation. Okay? So this is an important factor to understand, because that has radically changed the sentiment of a market that had, in essence, one single trade, which was be short the dollar, long everything else. And the unwinding of that trade is what is causing now the uncertainty that so many investors perceive. Bonds and equities are falling at the same time. Cryptocurrencies are not functioning as a hedge to inflation as some expected. Gold is virtually flat, so it's not doing much. And the dollar is strengthening. Okay, so what is basically happening in the economy is the unwinding of a massive carry trade against the US dollar. And by being the world reserve currency, the US dollar is able to sustain rate hikes with an increase of global demand for their currency. It is very important to understand, therefore, that in such an environment, what we are seeing as quantitative tightening is actually a lot more loose than what many investors perceive. If we look at the pace of rate hikes of the Federal Reserve, and certainly at the announcements of the European Central Bank, what we are seeing is, in fact, that central banks are going to be a lot more aggressive in their monetary policy and a lot looser. So quantitative tightening is affecting asset prices, but it's certainly not as tightening as one would have imagined. This not so tight policy is an integral part of the reason why we need to be more benign on asset prices in the future. And the main reason as well is that precisely because the central banks are going to remain accommodative and in numerous cases still providing negative real yields despite the rate hikes, because inflation expectations are rising, then what we show is that the reality of the economy is that central banks will remain looser than what many investors perceive, and that they cannot reduce inflation as aggressively as they expect with the current policies. To reduce inflation, central banks need to do three things. First, hike rates, obviously. Hiking rates reduces the pace of inflation increases, but not necessarily core inflation. The second thing that they need to do is to reduce the quantity of money in the system, i.e. stop the purchases of assets, increasing the balance sheet, increasing the money supply above demand. This is very unlikely to happen. And this is important to understand why it's very unlikely that there will be a 2008 style crisis, because liquidity makes it virtually impossible to reach a credit crunch environment. Third, governments need to stop increasing government spending and certainly need to completely cut deficit spending. Very unlikely. Okay? So, this leaves us with an environment in which it is probable that inflation will remain persistent for quite some time. Added to the supply chain disruptions and the challenges of the Ukraine war on cereals and certainly on energy, all of those factors make the increase in prices more likely to be persistent, and monetary policy being looser than what markets expect makes it more probable that core inflation remains elevated. Central banks need to continue giving a message of tightening, but it's very, very probable that they will at some point start to reduce those rate hikes and be even looser. The reason being that the economic slowdown is more severe than what they anticipated. And why is the economic slowdown more severe? Obviously, the Ukraine war is important. China is important, certainly. But the more important factor is that after a massive stimulus package, there is a boomerang effect, and the impact of even a small reduction of government spending negatively impacts GDP. We have seen it in the United States. So, central banks likely to be looser and likely to be more accommodative than we expect. Rate hikes likely to continue, but still leaving bond yields in negative real yield territory in many of the developed economies, certainly in the United States, certainly for sure in the Eurozone. Why is the dollar strengthening? Because the other currencies are undertaking an even more aggressive and looser policy. Their central banks are being even more aggressive. If we look at the Eurozone, the ECB has already announced that they can even add a new repurchase program in order to avoid bond yields from rising too high. So, tightening is going to be very, very limited. Second, they're already very far behind the curve in terms of rate hikes. Third, the element that leaves the euro strong in the usual market environment, which is a massive trade surplus, is shrinking. Imports are rising faster than exports. So, demand for euros is shrinking a little bit, despite being a very strong and being widely available used currency, but it's fundamentally used by the Eurozone countries themselves. So, in the next few months, what we're likely to see is that global demand for US dollars continues to rise. On the one hand, because global imports rise. On the other hand, because the demand for US dollars of emerging economies that have a strong level of deficits, both at the trade level and at the fiscal level, will need more dollars in order to continue to refinance their debt in foreign currency. On the other hand, rising rates in the United States leads to higher demand globally. The 10-year Treasury bond becomes more attractive as the yield reaches a certain level in which investors see that currency appreciation plus the yield is a better risk-reward option than Eurozone bonds, than emerging market bonds in local currency. So, looser monetary policy than what many expected. Second, government spending higher than what many expected. The level of government spending is very difficult to reduce, and we are seeing that, for example, in the United States, the government is unwilling to reduce government spending to a level that would reduce the deficit significantly. It is extremely important to understand this, because all of this means more consumption of newly created currency, newly created money. It also means that banks are unlikely to tighten credit conditions, to worsen credit conditions to a level that would create a 2008 style crisis. So what are we moving into? We're moving into a recovery that goes back to the trend in which we were in 2019, which is secular stagnation. The risk is inflation. The risk of stagflation rises. As investors in stagflation, we need to be aware of fundamentally two things. The first one is that the highest risk in the bond market relies on the sovereign bond part, because nominal and even nominal yields in some cases, like Japan or other countries in Europe, etc., but also real yields remain negative. But price appreciation is not something that you can expect, as we have seen in the first part of the year. So bonds, sovereign bonds, very high risk, because solvency is not improving significantly while the cost is too high. Risk reward is not attractive. Same in high yield, because solvency risk starts to appear as inflation eats margins away and the risk of repayment becomes more apparent. Same thing happens with consumption. We need to be extremely aware of the risk of consumption coming down, because so far consumption has retained a level of solid levels thanks to the fact that consumers have been consuming their savings. Consuming their savings. Very important, because in the next 3 quarters we need to monitor if consumption is going to start to see demand destruction, which is something that always comes after persistent inflation. The risks in emerging economies become too aggressive relative to developed economies. Why? Because of the currency factor, because of the margin pressure that many of the companies see, because governments need to curb inflation, and at the same time there is risk of social unrest. We need to be very aware of the risk of social unrest in emerging economies because of the rise in food prices. Remember that the Arab Spring came from an increase in food prices that reached all-time highs at the time. They're higher now. And the challenges of the Ukraine war in terms of cereal are likely to increase that risk in Middle East and North African economies. The Chinese slowdown is important. It's important because it's not just because of the zero COVID policy. It is also because of the collapse, or at least the massive slowdown in the real estate sector. The slowdown in the real estate sector is virtually impossible to offset with other sectors when there is an ongoing tech crackdown and retail crackdown. So what we need to understand is that China will take advantage of having a much tighter monetary and fiscal policy in the period of the COVID-19 crisis in order to implement a stimulus package. But the stimulus package is unlikely to generate the fiscal return that many expect, because the fiscal multiplier of stimulus packages is very, very weak in open and indebted economies, and it's proven to be extremely weak, even zero, in the case of, for example, China in the recent past. So China is likely to offset the risk but not generate higher levels of growth. So we have slowdown in growth, a cyclical revision of earnings that were too optimistic. Earnings revisions needed to come down, and they have been coming down. This has led to multiple compression in many indices, and this is a positive. This is a positive because the market is starting to price in reality instead of hope, and certainly not the mirage of massive credit and growth expansion that was impossible in any case. the biggest element in the next few months is going to be monitoring consumption, as I mentioned before, demand destruction as a very big risk. Second, obviously, is the pace of rate hikes and the possibility of central banks U-turning on their policy, and it seems more likely as the global economy slows down. Certainly in the European Union and in the Eurozone, that is very evident that the European Central Bank wants to remain looser for longer, and that certainly will leave the euro in an environment of weakness relative to the dollar for at least the prolonged period of time in which the trade surplus remains negative, in this case a deficit, or certainly very, very, very low. Slower economic growth. The market is telling us to look with the siren call of looking at the past and thinking about obsolete sectors, considering that margins are going to expand because of inflation. Let's be extremely careful about that. It's better to look at the future and companies that can maintain their gross margins and their cash flow balances and repurchase stocks than to look at sectors that have never been able to sustain margins even in a cyclical environment. Remember that in stagflation processes, the equity market tends to price better sectors with high margins and high cash flow than sectors with high exposure to the cycle. So the investor, an average investor, needs to look in general at having a portfolio that is adapted to an environment in which cycles are shorter, in which volatility is going to be higher, and that's a good thing, and in which valuations cannot expand constantly due to monetary expansion. But at the same time, needs to understand that central banks and commercial banks will remain loose and open to higher supply of credit because in general financial conditions remain positive and remain, although tightening, not as aggressively and certainly not even close to the levels of 2008. Difficult to get to a crisis of 2008 levels, certainly difficult to see a massive credit crunch in the economy, but the risk remains in inflation. The portfolio that we have to basically construct in this environment has to have a little bit of gold, silver, precious metals that allow the portfolio to have a cushion of assets that are decorrelated from equities and bonds. Remember that we have seen equities and bonds fall in unison in this first part of the year, and that's an important sign of how high correlation is and how high that trade, that carry trade was. And we need to have an exposure to equities that can sustain margins, that can have strong elements of cash flow generation with repurchase of stocks. Critical factor in my view. That makes it more interesting in terms of risk reward to be exposed to the United States and to developed economies than to emerging economies, where you have to basically take between 3 to 5 times more risk in order to achieve the same level of returns. And obviously in emerging economies, remember, the risk is currency. Second, the other risk is that many are state-owned entities, the ones that are quoted, and those receive the phone call from the government that they need to curb and reduce their margins in environments of high inflation, and obviously social unrest due to the challenges of supply. The Ukraine war is obviously now priced as something that'll be lasting for a longer period of time, and that's logical. The slowdown in China is not yet priced in, probably enough, but the government has tools to at least offset the risk of a financial impact on the economy, and this is not small. And this needs to take us again to not just having gold, dollars, and some equities, but to avoid in the bond market those high risk elements that are in the two let's say, most aggressive sides of the spectrum of credit. High yield because of the solvency risk in some of those companies and some of those issuers. We have to pay a lot of attention to fundamentals, and sovereign bonds because of the risk of both nominal and real losses. No? If we look at the next months, we're going to be, as the title of this event says, trading the headlines a lot. Which headlines are we going to be looking for as real catalysts? Change in the tone of central banks. It is not going to probably happen until the third quarter of the year, because first, certainly the Federal Reserve needs to be proving its independence and proving that it really puts measures to curb inflation, and the ECB significantly behind in those messages. Other things that we're going to be looking at: demand destruction. Number one, inventories are rising, demand is weakening, credit is being consumed, the access to savings is lower. So we need to pay attention to demand destruction, because a lot of the market has moved from underweight cyclicals to overweight cyclicals, and we need to look at that and look at that in detail, because when it happens fast, and it happens in a very vicious way. So let's pay attention to demand destruction and to the change of tone of central banks. Third, let's position our portfolios for higher volatility and shorter cycles. That is very important, because the likelihood of the risk of stagflation is high. We're still not in a stagflationary environment, not yet, but the risk is elevated. And in that environment, some of the allegedly safer stocks and the safer markets become more challenging. We need to pay a lot of attention to social unrest. Inflation is not irrelevant, and it's creating already significant problems in some marginal economies, not creating enough headlines, but it's likely to happen in a short future, and we need to at least monitor whether that happens or not. What we face in the next 3 years is an uncharted territory in terms of government spending, because on the one hand, governments don't want to reduce deficit spending, but on the other hand, central banks need to prove a certain level of independence. That is likely to clash in and present its evidence in the bond market. If we look at the currency market, everybody was talking a few months ago about the death of the US dollar. The US dollar has proven yet again that it is in a fire, the house with the highest number of windows and doors, and therefore it is likely to continue to be the world reserve currency, and likely to continue to be a reserve of value relative to other fiat currencies. Cryptocurrencies remain startup currencies. Like technology without profits, it is an extremely volatile financial asset, and certainly not yet reserve of value, unit of measure, and means of payment generally used. But they are going through the process. It's interesting to see that in these months, many of these assets have reached a certain level of a floor. But we need to be extremely prudent in the next months, because so far the indications that we see is that there is a certain element of bear market rally in these movements that we have seen recently, and that there could be another leg down. So we need to be aware of volatility. We need to be aware of the slowdown. We need to look at stocks that have good margins, good cash flows, and certainly good possibilities of repurchasing their own shares. We need to look at the dollar. We need to look at gold and precious metals as cushions that allow us to get decorrelated assets. And we need to get exposure to the part of the bond market in which issuers are strong in cash flow and low in future capex. In essence, what we're finding ourselves in is a very interesting environment. We need to go back to fundamentals. We need to look at the reality of numbers, of cash flow, of the reality of the global economic growth, which is slowing down. And it's normal because the trend that we're moving into is simply the one that we were moving into in 2019. Inflationary pressures likely to persist, core inflation likely to be elevated, even if some of those exogenous pressures subside because of the loose monetary and fiscal policy. Therefore, a very interesting environment that will be absolutely riveting for conversations, discussions, and certainly very exciting for all of us as investors. Thank you so much for inviting me to this event, and I hope that I shed some light on where we see the market in the next few months. Thank you very much.